Hello and welcome back. We're still on chapter 8 and we're going to spend a little bit of time working on exercise E8-8. This is on page 384 of the textbook. And this is an exercise which requires that we use both the percentage of credit sales as well as the aging of accounts receivable methods of estimating bad debts. So I'm going to read here. Innovative Tech Inc., that's the company name, uses the percentage of credit sales method to estimate bad debts each month, and then uses the aging method at year end. Now, I'm not sure if you recall, in the previous lesson I said that with accounts receivable, with the aging methods, it is okay to use both aging methods. And this is what I was really referring to. The percentage of credit sales method is a little bit easier to apply. And so a lot of companies would use that during the first 11 months of their fiscal year, at the end of each of the first 11 months of their fiscal year. And then at the end of the 12th month, at the end of their year, they would perform a more complete analysis using the aging of accounts receivable and use that method to come up with the final estimate of bad debts for the year. So again, this would be an example of doing that. So during November of 2010, the company sold services on account for $100,000 and estimated that 0.5% of those sales would be uncollectible. And so under requirement 1, they are asking us to prepare that adjusting journal entry of November 30th, 2010. And so what I've done here is I've shown the aging, which is what we're going to use in requirement 2. And so requirement 1 is right here, and that's going to be our journal entry applying the percentage of credit sales method at the end of November of 2010. And that calculation is based on sales of $100,000, and we're going to use a rate of 0.5%. So that's going to be 0.005. And so using our calculator here, that amount is $500. And our journal entry is recorded with a debit to bad debt expense, $500, and our credit is to our allowance account. Allowance for, I have doubtful accounts here. I'm going to change this to BD, bad debts, and use consistent terminology. So our credit is to the allowance for bad debts in the amount of $500. And so it's very straightforward. Using the percentage of credit sales approach, we simply take our credit sales for the month and apply our percentage of estimated uncollectibles for that month. We get those percentages from historical data, so we would go back a year or two. I think 3 to 5 years is a good time frame to work in for this type of estimation. to get an idea as to what our rates should be for the current year. So this would be our journal entry at November 30th. Now in requirement 2, I didn't finish reading the information up above in the exercise, but basically this is what it's telling us, that total accounts receivable is 89,000, and our aging shows us that of that 89,000, 75 is in the 1 to 30 day bracket, 10,000 is in the 31 to 90 day bracket, and 4,000 is in the over 90 day bracket. These aging brackets refer to the number of days that have gone by since the date of sale. The second line is the estimate of uncollectible percentage. So again, based on historical data, for our 1 to 30 day aging bucket, we estimate 1% of that amount may be uncollectible. For our 31 to 90 day aging bucket, we estimate 15% may be uncollectible. And for our oldest aging bucket, over 90 days, we estimate 40% of that amount may be uncollectible. And I think you can understand, it makes sense that the older an outstanding sale becomes, the less the chances that we will be able to collect on that sale. And so these percentages will tend to get larger as we move over to the right, and as those amounts, as those sales amounts become older. And so this is a calculation, a multiplication calculation here for each column. And so we come up with the estimate of amounts that we think we will not collect for each of the three aging groups, and the total, 3,850. So for requirement 3, well, I take it back. The other part of requirement 2 is to show the allowance for doubtful accounts with its balance before adjustment, and the balance before adjustment is a $1,600 credit balance. So we need to apply for the 12th month of the year for this company. We need to apply the aging of accounts receivable approach of estimating our bad debts. One thing you want to keep in mind is this balance of this credit balance of $1,600 already takes into account this adjustment we made at the end of November. Okay, so this is the adjustment at December 31. I should write that in. This is the balance before adjustment at December 31. So how do we apply this aging of accounts receivable method? Well, what it does is it provides us with the balance in the allowance account that we think we need. So our existing balance before adjustment is $1,600 credit, and the balance that we need to have based on our analysis of our aging of accounts receivable is 3,850. And we can call that balance after adjustment at 12/31. And so the question becomes, how much of an adjustment do we need? And I think if you look at that for a second, our allowance account is a credit balance account. And so to go from a balance of $1,600 to a balance of $3,850, we need the difference between those two amounts. Or $2,250. So at December 31, what is our adjusting journal entry for the estimate of bad debts? And it's basically the same entry as what we did for November 30th. We would debit bad debt expense, and we would credit the allowance for bad debts, and the amount of our entry is the amount we had calculated in this T account, and that amount is $2,250. So I hope you can see that in this example, the entry we make using the percentage of credit sales method and the aging of accounts receivable method is the same in terms of the debit account and the credit account. The amounts, of course, are different. But one important difference is that when we use the percentage of credit sales method, when we use the percentage of credit sales method, we do not consider the balance in the allowance account. We ignore the balance in the allowance account. We simply take credit sales and multiply that amount by our estimate of uncollectability. On the other hand, when we use the aging of accounts receivable method, we do an analysis of our aging of accounts receivable, and based on the amounts in accounts receivable and how old those amounts are, how many or how much, what amount is showing in each aging bucket moving forward, moving to the right, and then applying our estimate of uncollectability in terms of percentage based on historical data and multiplying those amounts out, we come up with a balance that represents the desired balance in our allowance for bad debt account. And then we consider the balance in the account before adjustment and the desired balance in the account after adjustment, and calculate the amount of our adjustment. So in this case, we simply subtract these two amounts to come up with the adjustment amount of $2,250. Then we do the journal entry, and the debit and credit accounts again are the same as what we used for the percentage of credit sales method. Now, when we for the last requirement 4, when we show these amounts on the balance sheet, we will show both accounts receivable, $89,000, as well as the allowance for bad debts, which accounts receivable is a debit balance, and the allowance for bad debts is a credit balance. And in this example, our allowance balance would be $3,850. And so our receivables will show at $89,000. This would be on the balance sheet. And our allowance will show $3,850, which is a credit, so that amount will be subtracted. And our net accounts receivable will be $85,150. And so that would be the amount of the answer for requirement 4 of that exercise. I hope this all makes sense. Again, this takes a little bit of time to get a feel for what's going on. I hope this has been helpful. Thank you for your attention.